How smart investors are preparing for the next global recession. The global economy is in a constant state of flux, marked by cycles of boom and bust. As the world experiences unprecedented levels of economic uncertainty, many financial experts and seasoned investors are closely watching for signs of an impending global recession. While recessions are inevitable, they don't have to spell disaster for investors. In fact, some of the most successful investors have built their wealth by strategically preparing for these economic downturns. So how are smart investors preparing for the next global recession? Let's take a closer look. 1. Diversification, the bedrock of a recession-proof portfolio. One of the most fundamental strategies in preparing for any economic downturn is diversification. By spreading investments across a variety of asset classes, regions, and industries, investors can reduce their exposure to any one sector that may be hit hard during a recession. Smart investors are mindful of ensuring their portfolios include a mix of stocks and bonds. While stocks can be volatile during recessions, government bonds and high-quality corporate bonds often perform better as interest rates drop. This balance between equities and fixed income securities can provide a level of stability. Commodities and precious metals. Commodities like gold, silver, and oil tend to hold their value or even appreciate in times of economic uncertainty. Gold, in particular, is seen as a safe haven asset during turbulent periods. Real estate. Investing in real estate, especially rental properties or REITs, real estate investment trusts, can provide a consistent stream of income and serve as a hedge against inflation. Alternative investments. Many smart investors turn to alternative assets such as private equity, venture capital, or even cryptocurrency. These assets are not always correlated to traditional stock markets, making them valuable tools for risk mitigation. 2. Building cash reserves. During uncertain economic times, liquidity becomes crucial. Smart investors are aware that having access to cash allows them to take advantage of opportunities when others are scrambling to liquidate assets. By building up a cash reserve, investors ensure they can weather short-term downturns and buy undervalued assets during the recessionary period. The key is to maintain the balance, having enough cash to capitalize on opportunities, but not so much that inflation erodes its value. This often means keeping cash in high-yield savings accounts or short-term bonds, ensuring it's not just sitting idle, but still earning some return. 3. Focus on defensive sectors. Certain industries are considered more recession-resistant because they provide essential goods and services. For example, sectors like healthcare, utilities, and consumer staples tend to perform better than others during a global recession because people continue to need their products or services, regardless of the state of the economy. Smart investors are actively positioning themselves in stocks and ETFs, exchange-traded funds, that focus on these defensive sectors. Companies that produce necessities like food, medicine, and household goods have a lower risk of experiencing large losses during economic downturns. Additionally, businesses with strong balance sheets and reliable cash flows are more likely to weather a recession, as they have the financial flexibility to continue operations and even invest in growth when competitors may struggle. 4. Increasing exposure to global markets. Global diversification can also be a key to minimizing risks during a recession. Not all economies will enter a recession at the same time or to the same degree. Smart investors often look beyond their home country and increase exposure to international markets, particularly in emerging economies. Emerging markets are sometimes less correlated with developed markets, meaning that when global markets are in decline, certain emerging markets could still be growing. Investors may also look to diversify their holdings by targeting countries that are not heavily dependent on global trade and commodity prices. 5. Hedging with derivatives. Another tool in the arsenal of smart investors is the use of derivatives for hedging purposes. Derivatives like options and futures can provide a way to limit potential losses during a downturn. By buying put options on major indexes or individual stocks, investors can potentially profit from a decline in asset prices or at least offset some of their losses. Hedging, however, requires a sophisticated understanding of these financial instruments and an awareness of the costs involved. As a result, it's typically used by more experienced investors who are comfortable navigating these markets. 6. Embracing inflation-protected assets. Recessions often coincide with inflationary pressures, particularly if central banks respond by injecting money into the economy through stimulus programs. In such scenarios, smart investors will look for assets that are protected from inflation, such as Treasury inflation-protected securities, TIPS, certain commodities like gold and oil, and real estate. Additionally, some investors turn to inflation-resistant stocks, companies that are able to pass on higher costs to consumers through price increases without significantly affecting their sales. These companies often operate in industries such as utilities, food, and energy, where demand remains relatively stable. 7. Rebalancing and taking profits. Smart investors regularly reassess their portfolios to ensure they're well-positioned for the upcoming economic climate. This involves rebalancing, selling off assets that may have become too large a portion of their portfolio, and redistributing the proceeds into undervalued or defensive sectors. By staying proactive and regularly taking profits from sectors that have seen substantial growth, investors can ensure their portfolios are positioned for resilience. This also allows them to lock in gains before the market downturn potentially reduces the value of their holdings. 8. Investing in the future, technology and innovation. While a recession may slow down certain sectors, history has shown that technological advancements and innovation continue to drive long-term growth. Many smart investors are positioning themselves in sectors related to AI, automation, renewable energy, biotechnology, and digital transformation. Recessions often create an environment ripe for innovation. Companies that can provide solutions to new challenges or improve efficiency in a downturn are well-positioned for growth as the economy eventually recovers. 9. Maintaining a long-term perspective. Perhaps the most important strategy for preparing for a recession is maintaining a long-term perspective. While economic downturns can be painful, they are often short-lived in the context of the broader economic cycle. Smart investors avoid knee-jerk reactions to market fluctuations and focus on long-term wealth-building strategies. By maintaining discipline and sticking to their investment strategy, even in times of volatility, investors can come out of a recession in a stronger position. The key to recession: proofing your investments. Preparing for a global recession doesn't mean retreating into cash or waiting for the storm to pass. Instead, it's about positioning your investments for long-term success through diversification, hedging, and strategic asset allocation. By focusing on defensive sectors, keeping cash reserves, increasing exposure to global markets, and taking advantage of new technologies, smart investors can not only protect their wealth during a recession, but also come out ahead when the economy eventually recovers. As with any investment strategy, preparation and knowledge are key. By staying informed, proactive, and flexible, investors can navigate the uncertain waters of a global recession with confidence and strength. Let me know in the comments section below. What do you think of our video? If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.